Yes. Okay, thank you everybody for joining. Once again, I'm Brad Steinberg, co-president of PWS. Hope the presentation was a good one on Tuesday with Aubrey from Alliance. Hope everyone enjoyed that. Today, a really great presentation by our head of finance, Anna Figueroa. I'll let her introduce herself in a second. But just wanted to remind everybody, I'll send out videos of this by end of day tomorrow, and then on Tuesday we will go over actual laundromats for sale, and we'll get into specific laundromats, and we'll talk about numbers and listings and all that kind of stuff. So that will be on Tuesday. We might actually just do it all together, all geographies and whatnot, and kind of highlight probably about 6 or 7 laundromats that we currently, and kind of hear about the way we think about the laundromats and think about, pros and cons of them and that kind of stuff. But there'll be actual laundromats that are for sale. So that's that. And then we'll set up meetings with everybody who wants it, one-on-one or a webinar, and we can kind of walk through the process of actually, making offers if that's something you're interested in, or actually operating a laundromat. We can walk you through a laundromat, so we can figure that out next week. But with that, I'm going to turn this over to Anna Figueroa, once again, head of our finance department, also going to talk about the tax benefits from laundromat ownership. So Anna, I'll turn it over to you. And whoops, I'm going to mute everybody, Anna, and then if you want to unmute yourself. Sorry about that. I just can unmute yourself, Anna.
Yep.
And then once again, for everybody, all right, star 6 to unmute yourself, and if you have any questions in the chat, and I will be monitoring the chat and can let Anna know when those come in. So with that, Anna, I'm going to turn it over to you.
Great. Thank you, Brad. Appreciate it. Welcome, everyone. I am going to be talking today here about financing your laundromat purchase and the tax benefits associated from owning a laundromat. So we're going to talk about the various transactions and such. Just a little bit of background and sort of what my department and who's involved. We have PWS has an in-house finance department, and we are the only distributor in the country that really has that in-house finance department with a combined 45 years of industry experience in the financing, basically for assistance of any laundry purchases or equipment financing. I've been here over 29 years. I also have, a group of sort of team members here. Ruby is my assistant finance manager, and she's been here over 13 years. And Matthew, who just joined the team a little bit over 6 months ago, and comes with obviously 5 years of finance experience. So we do have a good team of people here that can help you with the financing. I wanted to just talk about the different types of laundromats for sale. I think it's important to kind of understand the different types that are out there. We've got obviously FSBOs that are stores that are for sale by owner. Buyers will basically have to do their own due diligence on most of these, because if you're buying something, a laundromat without a broker involved, you're going to have to kind of try to do the due diligence on your own and try to really understand certainly the numbers of the store. So the financing, because the due diligence is not vetted by a professional, a broker, typically the options are limited for those types of transactions. So the other one would be obviously an acquisition, which is an existing store listed by a broker for sale. Those are numbers that are going to be vetted by an expert or broker consultant that will review the numbers. And that's what, PWS obviously does that here in-house. We do have a brokerage department that have the experience to do all that for you. And the newer the equipment, typically the stronger the collateral for lenders and the better the options. So the financing is definitely certainly more attractive in those types of situations where the equipment is newer. The development transactions are basically new stores built by a laundromat developer or even a contractor. We've had borrowers that are contractors themselves and they do it for their own. Typically it's brand new. They have no track record, but they do have a high potential based on certainly demographics. So that's definitely a great financing there because all of the equipment is new. And again, these are asset backed, most of the financing for these types of businesses. So you really are going to look at the collateral and how the stronger, the newer the equipment, the stronger the collateral. So, okay. In looking at the different types of laundromats, I want to also talk about the different types of lenders that are in the industry right now. We have obviously manufacturer financing that is out there for every type of equipment that's out there. There's a manufacturer. For us, obviously, we distribute the Speed Queen equipment, so we deal with primarily Alliance Laundry Systems. They are our main lender, and typically for the Speed Queen purchases or for purchases of laundromats. They're most favorable for existing laundry owners and new owners. They have loyalty to the Speed Queen brand. So they do have acquisition and retool programs that incentivizes the new equipment with purchase. So it's basically certainly an added bonus that they're able to provide better financing when in fact you purchase new equipment. They do have fixed and variable rate programs. They also have a hybrid loan available, which is a fixed rate for a specific period of time with a back-end variable rate. They can do up to 10 years, typically on the larger transactions, anything over $400,000, they do up to 10 years of financing. So you're going to look at that for possibly development transactions that have that higher dollar amount. They do offer deferral and interest-only periods, and that's nice to have when you're ramping up a new development store that needs to, you need to do the marketing and such, so you have that those options available to ramp up your business. There's no prepayment penalties on these loans, and the fees are up to approximately about 2.5%. The manufacturer obviously is the financing that I usually recommend. However, SBA lenders are definitely available. Now, SBA with the 7A loan, real estate is typically required as additional collateral. So a lot of borrowers are asked to put up their residence. Maybe it's a second there. And then the 2 years of seller's taxes are required. So typically seller's taxes, and fairly typical of a laundromat business, may not accurately reflect the income of the laundry. This is a laundromat is a cash business, so a lot of times income, the taxes are challenging with SBA because they will base the financing based on those seller's taxes. So whenever you are looking for a laundromat out there, I would certainly—
Today is March 2nd. No, today is
Hello?
4th. You want to come on 2 weeks on the 18th? I'll have some Brad.
Uh-oh.
I'll mute.
Okay, thank you.
I think that's okay, Anna. Sorry about that.
No problem.
Yeah.
So as I said, usually the seller's taxes are challenging an SBA loan. So you want to make sure you review those or ask for those right in the front end of the transaction during the due diligence period, so that we can make sure if that's the loan you want, that those seller's taxes can qualify. The SBA loans typically do have that lower variable rate. They do have the 10-year term. They are known for their prepayment penalties. Usually they have a sort of a scale down, like a 5, 4, 3, 2, 1 prepayment penalty for those first initial 3-4 years. They do have 4 to 6% in fees. And again, they do tie up your residence and the equity in your residence there. So, but they certainly are good loans if you're looking for that low interest rate 10-year term. Seller financing, we do have other laundromats and leasing companies available. Seller financing is sometimes, probably are often short-term notes. Sellers really want to see the return on that and fairly quickly. So, so it's important to understand that certainly seller financing is definitely an option, but you're probably not going to get the longer terms. You can negotiate that maybe a little bit better with the sellers. You can negotiate possibly a lower rate. There might be some prepayment penalties for seller notes, but there's certainly the lease out of all three. They're also an option for financing the laundromats. Okay. I wanted to just kind of touch upon the financing with Alliance. PWS, you know, we have financed over $250 million of transactions through Alliance over the last 15 years. As of November, obviously our portfolio was about 52 million. It's probably gone up a little bit since then. But we do have a 95% approval ratio with Alliance, which is nice, of which, you know, 68% of all of our deals are financed with Alliance. So, and I'm getting a little bit of feedback. Not sure who's got their muted. There you go. Thank you. I do want to point out that, you know, we do have a 1% delinquency ratio on our loan portfolio, which means we definitely vet our loans. We go through them. We make sure that it's, you know, we do the due diligence and make sure that, you know, it's a good investment for our borrowers. So we are an added step to kind of your due diligence on the transaction. We do assist with the online application submittals and the loan documentation, which is nice because we can definitely assist you and hopefully expedite the deal since we're helping you with the transaction. We do coordinate any pending documents needed from you. In addition to discussing the options that you're going to have on the financing prior to, you know, providing a formal approval to you. So we obviously take our time to make sure we put you in the right loan. So to me, that's extremely important to make sure that, you know, we're helping you through the process and assisting you and making sure you're successful. We also assist with landlord documentation requirements. Most lenders out there for these types of transactions will have a landlord document that is required to be executed by your landlord. So it is important to have somebody that knows those documents, understands the documents, and is able to explain them to your landlord. A lot of landlords obviously at first may have an issue with signing a document on for a lender. But once they, you know, you actually take the time and we explain it to them, they're able to understand the purpose of it. Okay. The types of transactions that are financed by Alliance, we have the acquisition financing for existing laundries, and that's for a purchase of an existing laundromat. We have, they also do the new store development for leased or owned properties. If you own the property, they also can finance that for you as far as the development and the equipment that's going to be located at the laundry. And of course, just an equipment replacement transaction for existing laundromats. So these are the top 3 transactions that Alliance does. However, they also have other programs, which is nice that they're able to expand on their program portfolio and offer an equity cash out financing on existing laundromats for the purchase of another laundromat. So essentially we've done this, and I've done this for many of our good customers that have owned 2, 3, 4 stores, where you could pull the equity from their laundries and purchase another laundry with it. So you're really capitalizing on that equity on that business that you've, you know, worked so hard to kind of get up and running, and now you're able to use that and purchase another laundromat. So that's really an exciting program. We do also, you know, are able to get remodeling funds with the new equipment purchase. We're able to finance that as part of the financing. And then we've also do refinancing of existing debt with new equipment purchases. If you have a loan with another lender and you want to try to refinance that when you purchase new equipment for your business, it's definitely a nice program because you could reduce your interest rate and you could extend the loan term and buy new equipment all at the same time. And of course, we do assist with loan modifications during difficult times. And, this past obviously year, has really brought to light how important that is. And Alliance has assisted customers that have certainly needed a little bit of assistance during the pandemic, just to get over these times. Certainly it is important to know that they're there and they act as your partner, long-term relationship partner with you. As it pertains to the Alliance Acquisition Financing Program, this is basically a nice program because Alliance does incentivize immediate retool with Speed Queen equipment, meaning when you buy a laundry and let's say, the equipment is 15, 12 years old and you're going to need to replace that equipment in the near future. What they do is they incentivize you by assisting you with putting less down payment into the purchase of the store so you could actually buy equipment to re-equip the older than 10-year-old equipment that's in there. So if you see based on this chart, you could see that if you look at a store that, that is non-Alliance branded store, meaning, brands of equipment that Alliance doesn't distribute, then they would require you to put, essentially here a 25% down if you retool the equipment that's in there. So you could get into an existing store. If you retool it, you could actually put 25% down, 25 to 30% down based on certainly how much equipment you replace at the time you purchase it. So we have a lot of our customers that have taken advantage of this program. It certainly is pretty amazing that you can come in and really on an existing store with 25 to 30% down. So they do incentivize obviously that retool with Speed Queen equipment. And they figure you're going to do it in a year or two, why not do it now and incentivize you for it. So it's really is a good program. Just to give you an example, I know there was a lot of numbers here and just I wanted to just kind of put it to you as simple as possible when it comes to the acquisition retool program that we just talked about. If we have a store that has, is for sale and you buy it for $500,000, you can actually, assuming that the equipment is older than 10 years old and you're going to be replacing some of that equipment, you can come in with a 25% down and obviously finance the difference there at $375. The standard acquisition rate is $699. And the reason why they're only giving 5 years is because that equipment is definitely older than 10 years. So, but if you put in new equipment and you're replacing some of the washers in the laundry over 10 years old, and then you combine obviously the loan amount from the purchase of the laundry and the new equipment, you have a combined loan amount of $525,000, and they will incentivize you by reducing the interest rate and give you possibly a 9-year term. That reduces your monthly payment there to $6,300 per month. And on top of that, obviously you have your savings and utilities that you're going to have from the new equipment and decrease your expenses on repairs and maintenance from the older equipment. You obviously have, you're protecting your cash flow there by increasing the revenue and raising the vent prices with the new equipment. So you're able to, reduce your monthly payment, save utilities, decrease on repairs and maintenance, and possibly also increase your vent pricing on that new equipment with, certainly a promotion and such. So there's just a lot of potential here, and this is why the program is so good. It really has worked, and our customers are definitely taking advantage of it. We also, obviously, you can manage stores with innovative technology using the Speed Queen Insights, which we talked about in your last webinar here with Aubrey. So again, this is the program. I mean, it's meant to give you an example of how it works, and and definitely could change. Numbers can certainly change, but it's why this program is so popular. The new store financing is definitely very popular as well. These are, development stores. So Alliance does finance up to 70% of the total project costs. This includes equipment and construction. They do up to 10 years on the transactions over 450,000. Otherwise, it'll be a 9-year term, which is still a very good term. They typically do the no payments for 90 days from the date of funding, and interest accrues, of course, is capitalized into the loan amount. They also have this 10-month of interest-only payments during the first year of the loan. And, I have seen them go up to 16 years on the new stores, which is nice. I mean, that to me is pretty amazing because they're able to give you that time to really ramp up the business. Again, ramping up by doing the marketing, doing the promotion. And it's definitely very helpful when you have a new development store. Interest rates are as low as 5.99, and there are fees associated with this. 2% plus $300 are included in the loan amount. So these types of loans have no prepayment penalty to pay down or pay off the loan. The nice thing about this is when if you pay a 20% down, they do re-amortize the loan. So during the course of the loan, if you want to put a 20% down, let's say the business is doing great, and you want to certainly pay down that debt, you can do so without any penalty. And then they also re-amortize the loan for you, which is nice, which brings down your monthly payment. So that's definitely a plus and also something to consider. We do require the personal guarantee as part of the loan documentation. So all of these loans will require personal guarantees. On the Alliance Equipment Replacement Program, we have promotional rates available during trade shows for a limited time period. So the spring and fall show promotions are pretty amazing. We actually do have a pretty incredible one right now. Where the manufacturer basically is saying no payments for 2021. So that is a pretty incredible promotion that they're certainly have provided to all of our customers, where if they replace equipment, they really have no payments for all of 2021. They have a standard variable rate based on the length of time of ownership and your credit profile, and of course the location strength. They do have a fixed rate program. They vary based on the length of time of ownership, and of course the credit and the location. Typically, they have the 90 days deferral. That's pretty much a given with Alliance. They want to make sure the customer has time to really enjoy the benefits of the new equipment before they make their first payment. So it's nice for them to give you that ramp up period. Again, up to 10 months of interest only during the first 5 years of the loan. So that's definitely nice. And then 2% loan fees plus $300 included in the loan amount. And again, there's no prepayment penalties, and the 20% pay down is also available with this equipment replacement program. I wanted to talk a little bit about the tax codes, just to give you a little bit of insight into, what are the advantages. I'm not an accountant. I want to make that very clear when I speak to customers. I do say that. I say it again, I say it twice, I say it 3 times, because I want to make sure you understand that I'm only just giving you information that you could take to an accountant and really talk to them about it, and so just to give you an idea what's out there. To me, it's important to really understand the tax codes for these types of businesses. You want to work with an accountant that is familiar with laundromats. And we have certainly referrals that we can give you. We do work with some of them and know them. Section 179 depreciation combined with the bonus depreciation provides a unique opportunity to shelter your income on these businesses. So it's important to remember that when speaking to your accountant, if you don't already know about it. The most sophisticated operators do find ways to keep deferring their taxes, and really that is the long end of it, right? You want to be able to benefit from these businesses. When you ultimately sell your laundromat, remember that depreciation is written off in prior years. It gets recaptured and is considered ordinary income for tax purposes. So, and your accountant can definitely explain that to you a little bit more if you want a little bit more insight into that. But you want to make sure your core business provides a good ROI even without the tax benefits. That is important. So if you make good business decisions and get tax benefits, it's definitely a win-win here. And that's what we want to make sure you get. What is Section 179? And just in a sort of a small explanation of it and quick. Section 179 is of the IRS tax code allows businesses to deduct the full purchase price of qualifying equipment and or software purchased or financed during the tax year. This means you can deduct the full purchase price from your gross income. So that's really important. It's good for new and used equipment, and that's new in 2020 for used equipment. Equipment needs to be installed and put into use between January and December, and I think it's going to go on for 2021. I think it's definitely something that it's available still. Section 179 does come with limits. There are caps to the total amount written off, so you want to make sure you're clear on those. But essentially, it's basically a 3.6 million sort of cap on that. So once you reach that, just make sure that you are kind of aware of that if you're buying multiple laundromats. The difference between the Section 179 and bonus depreciation, the Tax Cuts and Jobs Act increased the bonus depreciation percentage from 50% to 100% for qualified property acquired and placed in service after September and before January 1st, 2023. And that's on irs.gov, by the way. So you could definitely read about that a little bit more in the website. In previous years, bonus depreciation only included new equipment, and this is new. That changed in 2020 when they actually included both new and used equipment. So what's in most of the laundromats, when you purchase an existing laundromat, that would be used equipment. So it's equipment in use already, and it would definitely qualify. So it's very helpful. Bonus depreciation is useful to very large businesses spending more than the Section 179 spending cap. Business with a net loss are still qualified to deduct some of the cost of new equipment and carry forward the loss. So that's really important. Section 179 is usually taken first, followed by bonus. So unless the business had no taxable profits, because the unprofitable business is allowed to carry the loss forward in future years. Again, this is all something that can be reviewed with your accountant. So what you want to make sure you get this tax trifecta of write-offs for laundromat owners. Section 179, bonus depreciation, and then your interest tax shield, which basically is your interest expense because they are tax deductible from your loan. So they're definitely a nice trifecta. I always look to see this in tax returns if customers are doing this right, and most of the customers are definitely taking advantage of it. So that's definitely a good thing. The equipment write-off, I wanted to just give you an example of how that works. If you buy an existing business, not only are you obviously taking advantage of the Section 179, but equipment write-offs are definitely part of it. So equipment purchases, here's an example of the calculation with no financing, just to give you an idea how it works. If you purchase equipment 1.1 million and your first year write-off obviously is $1 million based on Section 179, 100% bonus first year depreciation, an additional 150 based on your purchases. And so your total first year deduction is 1.1 million, obviously, with cash savings there, which I had 35% tax bracket of 400,000, over 400,000. So your equipment cost after taxes is obviously, assuming a 35% tax bracket, would be about 747,000. That's huge, and definitely something that you should be discussing with your accountant. So in the laundry business, you may be able to fully finance this 1.1, which is what I would encourage you to do. Instead of paying 1.1 million up front, you could pay $14,000 a month in debt service payments. And in year one, you could save close to 400,000 in cash flow from your tax savings. So again, all these things are pretty amazing when you combine them. And it does get better. So you can deduct that interest expense that we talked about. So if you buy certainly 150,000 of equipment and you finance it, the cash flow with equipment purchase versus the cash flow with no equipment purchase, it definitely makes a big difference there at the bottom, with $15,000 there versus 70,000. So it really, there would be, obviously you have some debt service payments, but the cash flow difference is huge. Okay. And then the tax benefits of buying an existing laundromat are pretty darn good. In most cases, buyer and seller negotiate an allocation of the purchase price as part of the sale. So, you have an allocation will consist of fixtures, which is typically what your equipment allocation amount will be. Goodwill, leasehold improvements, all that stuff is part of the allocation. So the amount allocated to equipment, also known as fixtures, can then be depreciated using the Section 179, which is used equipment there. So that's really a nice benefit. Additional equipment added to the laundromat could also be depreciated using Section 1 if you purchase new equipment with the purchase, which is the program that I was talking about earlier, an added plus. And then the buyers using financing to complete a purchase will also get the benefit of the interest tax shield discussed in the previous section due to the financing. So you could write off those interest expenses as part of your deductibles. So these are just steps to success that I always remind my customers. Work with a good partner, a broker, a distributor, lenders, an accountant. Have that core group that you can go to, pick up the phone, and really have a good discussion with them about what you want to do, why you want to purchase, and certainly find a good investment. And hopefully the broker or your accountant or lender, somebody certainly can give you their opinion. We're certainly here to give you our thoughts and opinions as to the purchase that you're looking to do. And defer. Obviously, that's very key in my opinion. Using all these tax benefits, you should be able to do that. And of course, be your own boss. I definitely, certainly have heard a lot of our customers say that, that's definitely a plus of owning a laundromat, being your own boss. And certainly that's led a lot of our customers to this industry. So that's it. I appreciate you guys attending. I can take any questions if you have any questions now about the presentation. Okay. Okay, I'll take that as a no. Thank you, everyone. I appreciate it.
Yeah, and I'll just say there are a lot of people in this industry who are in this industry because of the tax benefits. And they're absolutely tremendous, as Anna just went through. I think it's a lot to take in. And this is one where I'd recommend watching the recording of it, because you can really, it's not never pay taxes, but defer your taxes and continue to defer. And that's what the good laundromat owners do. They buy one store and they get a big tax write-off in year one. They buy another store a few years later and another store, and then they sell one store. Now you got to pay, you essentially got to pay back those taxes, but they add equipment to one of their stores, and then you get to defer taxes for that year again. So you're constantly playing. I don't want to say this game is saying that it's something nefarious or illegal. It's in the tax code and it's totally allowable, but they're always deferring, and it's extraordinarily powerful. And something that we're fortunate to be in, to be able to have this kind of thing. So I see there's a chat here, Anna. What was the question here? Just to confirm with Section 179, the entire purchase of the laundromat is deductible, or just a portion allotted as equipment? It's a great question, and it is just the portion that is allotted to equipment. So when you buy a laundromat, there'll be, if you buy a laundromat that's an existing laundromat, there will be an allocation in escrow, and the two big the big thing is equipment. How much of the purchase price is allocated towards equipment, and then how much is allocated towards goodwill or some other things. And the portion that is allocated towards equipment is the depreciation that Anna discussed that can be used for Section 179. And the real power becomes, hypothetically, you buy a laundromat for $300,000, and it's a negotiable item, the allocation between equipment and goodwill. And let's say you get $200,000 allocated towards equipment. Let's just say that that's where it lands. And then you add another $200,000 of equipment because the store needs to be remodeled. You now have $400,000 of depreciation, $400,000 that you can take year one that goes against your taxes to shelter or defer taxes for that particular year. So that's the incredible part. But great question about what portion is deductible. When you are building a brand new laundromat, most of what you're doing is equipment. So people who build a brand new laundromat and they spend $800,000, $900,000, it is up to consult your CPA, but you're going to have a very large percentage of that build out cost towards depreciation, which then towards equipment, which then you can depreciate, as Anna said. Another question: are laundromats profitable because they have so many options to defer taxes? Once you are past the point of deferring, do profits significantly dip? So, this industry, and it's something that I spoke about, and that's a great question, but, we talk in terms of multiple, of cash flow. And so this industry sells at a 4 or 5 times, I'll just use those as examples of cash flow, meaning you're going to get 20 or 25% return on investment, maybe 18% or something like that, depending on the store. That is cash on cash return that has nothing to do with the tax benefits. So then you layer in the tax benefits and it becomes an extraordinarily incredible return. Why is a laundromat, a higher return possibly than obviously putting your money in a bank? I'll just use an extreme example. Well, it's riskier. Someone could open a store across the street. You could be not a great manager and let the store, dip or something like that. So there's a risk to any business. And so, you're going to get a return commensurate with that risk. I think the formula and why, I'm sitting here today and why there's, a big laundromat industry is because that risk return formula is pretty powerful, particularly when you layer in the tax benefits. It becomes even more powerful. But the underlying business has to work. The underlying business has to work. And the last thing I'll say on it is most laundromat owners are pretty cheap. They don't replace equipment as much as they should. And part of it is they don't look at the whole picture, and that whole picture doesn't just involve how much cash you put in your pocket every month from the operations of the laundromat. The whole picture is how much cash you put in your pocket and what you can save on your taxes as well. And so the good operators understand that it's this, more of a larger picture. And you add those together and it's really powerful. Anything else? Any other questions, comments? Okay. Awesome. Well, thanks for attending. If there's any other questions or comments, feel free to reach out. We have one more. I'll let you take this, and I know it can vary, but the question is, what's the best business structure to hold the laundromat in? You want to kind of talk about what most people what most people do?
As it pertains, certainly with the best business structure, when you purchase a laundromat, you certainly have different options in how you want to buy it. Now, I'm assuming you're referring to whether you want to purchase it via an LLC, an entity, or a sole prop. The LLCs are definitely what most of our laundry owners certainly create for the purchases. They do have a lot more tax advantages, and certainly LLCs seem to be sort of the pick of most of our laundries to purchase. And LLC taxed is an LLC taxed as an S corp. No, it is different. It's definitely a different tax bracket and certainly guidelines when it comes to that. And certainly you can talk to an accountant. I'm sure they can give you the differences between the two, but they are different. But yes, the LLCs do come with certainly a lot more tax advantages than a sole prop.
Most of our most customers end up with an LLC. It gives you protection. It limits your liability as far as piercing that structure, and then also gives you personal tax advantages. So you own a laundromat, and that laundromat makes $100,000 a year profit, but you've added $200,000 of equipment. You can not only deduct the depreciation from the actual laundromat, but from your total income that you make, your active income, that you make on your tax return. So let's say you made $100,000 in your laundromat and you make $100,000 in another job. Federally, not state. Federally, you can limit those taxes through Section 179 or bonus depreciation. So, okay, I think that's everything. Once again, anything else, feel free to reach out, and I'll email these. I'll email these tomorrow, and then we'll chat again on Tuesday afternoon. So thank you, everybody. Have a great weekend. Take care.
Thank you, everyone.
Thank you, Anna.
Bye-bye.